Okay, cool. Well, thank you everybody for joining us as we enter June. It's a beautiful day, next to the last day of school for my little one, and vacation is looming. So exciting. Today we're going to talk about how to manage your money. Part 5, phase 2 of our tiny training series today, presented by Montana Child Care Business Connect, 0 to 5 Montana, the Department of Public Health and Human Services, and our partners at the Small Business Development Centers. As a reminder, our tiny training series, our 30-minute webinars every other Thursday will get you 2 hours of credit if you attend 4 of these live. We're trying to define some basic business concepts, which we'll do today. We've got a couple more after this one. We've got how to sustain your without one-time funding. We're going to talk to 2 public school administrators about how public schools are funded and how that's relevant to the ECE system. And then we'll wrap at the end of June with community-led solutions. As a reminder, Child Care Business Connect was founded in 2022, a program of 0 to 5 Montana. Our goal is to serve communities and entrepreneurs on the business elements of starting, owning, operating, growing, expanding, stabilizing, and whatever else business stuff is relevant to people. We do 5 different things, stuff like this: training, one-on-one technical assistance, our mentorship accelerator. We've got community capacity, and effective today, our web resource hub is live at childcarebusinessconnect.com. Rhonda's our program manager. I'll introduce you to myself here momentarily. Haida is our marketing and comms specialist. Shelby and Alex do our community level work, and Jennifer designed our mentorship program. We are hiring as well for a business advisor and a program assistant. Today, I'm going to show you my name is Jason Nitschke, Senior Child Care Business Advisor here at 0 to 5 and the Child Care Business Connect program. Today, my resume is to highlight our legal statement, which is I am not a CPA, I am not an accountant, I am not a financial advisor. And so none of the following should be construed as financial advice. We're going to be talking specifically about best practices and things that I've seen and witnessed as best practices in advising entrepreneurs over the last 9 years, and then also successfully failing in my 2 attempts at entrepreneurship. We're going to talk today about some basic terms, money management tools. We're going to create a system for you, I think best practices related. We're going to also help you understand timing, and then talk briefly about revenue diversification and pricing. As a bit of a overview here, I'm going to skip over some of the standard stuff you may have read in the past about data management, customer service, ratio management, payment types like copay, scholarships, etc. Family notice when leaving a program. I'm going to try to fill in gaps that I have seen during my review of existing materials out there on this topic, customize that stuff to the childcare programs as best that I can. And on this topic, I'm also going to try to avoid some of the standard business training that is out there on the topic of managing money, because I think it oftentimes gets too bogged down in the minutia of business schoolese, if that makes any sense. In my experience, if you wanted to go to business school, you would have done that already. So I'm going to approach today in the next 30 minutes from a practical, logical flow of consciousness mindset that hopefully makes some sense to operators. My goal is to fill in some gaps that I have seen in other materials on this topic. And I also want to make this implementable as part of your daily, weekly, monthly, and annual routine. Call it a money management policy and procedure for your program. So that's the overhead background. Let's first talk about our mission as a program here at 0 to 5, the Child Care Business Connect program. Our mission is to give you the key to financial literacy for your program, because with financial literacy, there can be financial management. With financial management, there can be financial control. With financial control, there can be wealth building in your business. And with wealth building in your business, you can bless your employees with financial security. We're going to do that by talking about 3 business essentials: planning better and more comprehensively, promoting and selling your brand better, and making better financial choices. So let's first start talking about terms. The first term I want to talk about is business legalese stuff. It's called cash flow. And this slide I've created kind of as a amalgamation of a bunch of the same types of slides that I've seen. Ultimately, what we're trying to illustrate here is terminology and what it means and how it applies to you. What I'm trying to illustrate again, all money in and all money out of your business. Money management is about understanding all money in and all money out. And that is not just revenue and expenses. Those are two things that are tracked on the income statement of a company's financial statements. An income statement is one of three financial statements. So just to walk through this flow chart here, the business activity, an equivalent financial term. The sale of your service or your products, if you do that as well, is called gross revenue. That can also be related to cash that comes into your company, the inflow. The engine of your company is the providing of the services, delivering the value to the customer. To be able to do that, you've got expenses incurred and corresponding cash out obligations. So when you incur those expenses, then you have to pay those expenses. So those are obligations owed. The financial term is accounts payable. Our ultimate goal in business is to make money, not move money. It's better to go from $0 to $1 than it is to go from $0 through the process to $0. So we're trying to make money in a business. And we do that in two different ways. We generate net profit or loss, that's on the income statement. And we also have to track our cash on hand and access to cash. So those are some of the financial terms related to cash flow. In my review of materials as I was preparing to do this, I found some material from a guy that I started reading about 7-8 years ago named Philip Campbell. He's got a book out there called Never Run Out of Cash. I found a flyer and some additional materials called The 7 Deadly Cash Flow Sins. And the thing that jumped off the page when I was reading Philip Campbell's work is that it's the critical element of business failure. Running out of cash is the definition of failing in business. And so to be able to not run out of cash, we have to be able to manage our cash and manage our money. So cash flow, that's one term. The second term are the sources of cash. And so these are three terms. So I'm going to throw some definitions really quickly on some of these things, and they are relevant because I'll cite back to them as I talk over the next 20 minutes. But revenue. Revenue is tracked on your income statement. It is earned income through the sale of products and services. It can also be, but isn't necessarily, gross revenue, grants and gifts that come through. They may be defined as gross revenue. Typically, they're defined as other income, but oftentimes, many of you are aware, who've received stabilization and innovation grant money, it's taxable money. The second source of cash is debt. Debt is a liability that you owe back to the lender, whether it's a bank or another person. It's not a replacement for earned income because it has to be paid back. However, it can be an effective and necessary tool if you're going to use it wisely, smartly, and align it correctly with the use of funds. The third source of cash in a business is equity. This is a contribution from your bank account as the owner into the company. It could also be an investment from a third-party investor that may have ownership of that company or not. The way that equity gets paid back is via dividends or the wages that you earn as the owner, if you are the owner. So those are three primary sources of cash, and again, relevant to future discussion here. The next term I want to introduce or remind you of is the term working capital. And yes, I'm conscious of the business legalese here. So the simplified definition of working capital is the money that you need to operate the business. It's kind of the money in the bank, but not necessarily fully the money in the bank. The accounting definition of working capital is current assets minus current liabilities. So you can kind of see that money in the bank isn't necessarily an accounts receivable, which would be money that you've invoiced for and have not received by a payment yet. And inventory, not to be confused with furniture and fixtures, or classroom materials typically is going to be food and products to be sold. The liabilities that you have, the current ones, that's money due back to whomever you owe it to within 12 months. It's critical to know how much this working capital number is. And we can calculate that. So if this is something that you're interested in, I usually use about 6 different methods to calculate working capital for a company to create a range so that we can kind of see most likely what your business needs to operate, how much that is. And I also would consider that 0. That's the minimum number, 0 not being 0, 0 being your working capital number. So 0 is never 0. And especially this concept is important if you're planning growth. For many of you who are innovation grantees, planning growth requires working capital. We need to know what all potential and future outflows of cash are. And how do you pay for it? With working capital. The working capital cycle is a cyclical process. It is going from cash through expenses, through cash out, to collecting cash and putting it back into the bank account. Same terminology, cash flow cycle, working capital cycle, same deal. But as you go clockwise around this flow chart here, the working capital cycle is the amount of time and the amount of money that it takes to get from $1 back to $1. Another term here in these next 3 are your financial statements. Income statement, also known as your profit and loss. Really important to recognize here that an income statement is not a comprehensive indicator or reflection of all money that comes in or all money that goes out of a company. It is a tracking of sales, expenses, and profit, which is not, again, all money in and all money out. And I'll use the example that I often use related to debt obligations. On the income statement, your interest is tracked as a business expense. The principal payment, which is cash coming out of the company, is an asset building activity. So it is represented on the balance sheet. A balance sheet is what you own and how you paid for it. And unlike the income statement, which is a reflection of a snapshot in time, a balance sheet is an indicator of your business's health since the day it started. The third financial statement, and again, I think this is important to understand and define as we talk about money management, is the cash flow statement. In short, the cash flow statement is the least, in my experience, the least understood of all the financial statements, and yet it is the most comprehensive reflection of all money in and all money out. So my point here is we need to understand when we're doing budgets, all income statement projection, all balance sheet projection, and all money in and all money out projections through cash flow statements as well. Okay, those are terms. Let's talk about tools. I think that there are about 4 money management tools that absolutely 100% have to be used in business. The first is your bank account, and not only just one bank account, but multiple bank accounts. And if you can make this, I'll use a personal analogy with my personal budget. All of us have checking accounts, typically what they're called. My bank calls it some fancy name. I don't even know what it means, but it's a checking account. That's your operational account with your business. I manage my personal escrow account for my mortgage on my house. So I have a savings account. It could be a money market account as well, that I put money into. I pay money into that every single time I get paid. And then when those bills are due, I have the money available to pay that out. In business, we can call those sweep accounts. We're going to sweep some money aside for rainy day funds, future expenses, projected expenses, unknown expenses. It's a savings account. And I'll point out that what you have in the bank right now is not necessarily a sufficient financial management tool alone. It's important, but it's not the only thing. And by the way, profit is not an indicator of financial health. I have had this conversation hundreds of times. Cash is not profit, profit is not cash, and a lot of businesses are profitable, but they're broke. Those two things can be simultaneously happening. So money management tool number one. Number two, bookkeeping programs. It still surprises me that in 2023, not all businesses use bookkeeping programs. And I'm not talking about Excel sheets. I'm talking about bookkeeping programs. FreshBooks, Quicken, QuickBooks, whatever you choose to use the tool every single day or hire someone who can. Number 3 out of 4 here is your CMS, your childcare management system. And again, not everybody is using childcare management systems. To be able to maximize the utilization of your childcare management system and have it benefit your money management strategies in your company, you have to understand what the full functionality of those programs are, and then utilize the tools within that program to help you collect, maintain, and manage. And all of these various programs, Brightwheel, ProCare, they're all a little bit different. The in-home programs that are specialized for in-home program, a little bit different than center-based programs. So understanding the full functionality and then utilizing the full functionality of those CMS programs. And then the fourth tool in money management is actually human capital. This is your money management team. And I think there are some critical questions when you're talking about who is on the money management team for your company. Who does what? Who's in charge of what? Who reviews what? When do they review it? Who has access to that information or those accounts? And what are they allowed to do with the access to those accounts? Far too often, just blindly giving somebody control over your bank accounts, check writing procedures, that is a pathway to theft and people being stolen from. And it's in the news all the time. So who makes financial decisions versus who makes financial recommendations, and who is ultimately the backstop for financial decisions. So I think those are the 4 critical money management tools to be utilized. And then that leads to our system. The system in my mind is 5 steps. Number 1, the forward-looking budget. And this has to be comprehensive in its cash flow analysis. It's got to include all 3 of those financial statements I talked about. It's also got to include the things that you're not thinking are going to happen when we're doing budgets. Most people have rose-colored glasses on when they're doing budgets, and they disregard the reality of bad debt and uncollectible tuition. They forget how much has been invoiced and how much is being paid and by whom. And what I'm speaking about here is for those of you who have, say, one child who has 2 or 3 different sources of payment for their tuition, whether it be Best Beginnings, copay, and maybe an employer-sponsored compensation, understanding how much has been invoiced, to whom, and when it's going to be paid, or how much of that person's tuition has been paid. We also got a budget for late fees. You do have the legal right to collect late fees, and you do have a legal right to charge interest on past due accounts. So my message here, budget for what you don't know. The question then, how much? Call it 2% a month. Add 2% a month to your expenses. That gives you 25% margin a year to be able to account for what do I not know and people trying to steal from me. Call it loss, theft, and waste. So budget number 1, financial statements number 2. Looking backward or financial statements. Budgets look forward, financial statements look backward. Got to have a bookkeeping system to be able to do that. And again, not just talking about income statements, we've got to include income statements, balance sheets, and cash flow statements. Step 3 in the system is to reconcile those statements. And the best practice in business is to not wait until tax time to be able to do that. If you wait until tax time, you can't make real live decisions in the moment. So best practice, look at your statements every day. If you do that, but close your statements every month within the 10th day of the previous month, and reconcile your financial statements with your bank accounts. Step number 4 in my mind is to review with your team. Those can include your internal and external team members. Analyze, ask questions, and then make planning decisions about when money comes in, how much money you need to come in and when, and then plan for outflows of cash. If you're not going to have enough money to pay, for example, an insurance premium or your quarterly taxes, then you need to make an active decision on that based on the money that's coming in and the money you have available. And then compare yourself to others. We all do it, right? We do it in our real lives. We do it one way or the other. This is what social media is about, I think. But industry financial benchmarks are a way to compare your business to others in your industry. And it helps you identify areas that you can be better by line item, by category, and by ratios. Not meaning ratios teacher to student. I'm talking about business financial ratios. Where do you get industry financial benchmarks? Well, you may not be able to see me right now, but you can hear me. I can give them to you for free. The next thing I want to talk about as we get close to closing here is understanding the timing about when money comes in. So if you don't understand your invoicing periods and have set terms when you're going to be collecting or when you expect your families to be paying you, then you're leaving it up to them to pay whenever they choose. You can communicate your late fees and your interest charges in that process as well. Receivables periods, that's the period of time in the working capital cycle. When does money go out? When does it need to come back to you? And how long do you incur your expenses and your cash out obligations before receiving money back? The timing of payment types is also really important and also relevant to your childcare management system. Prioritization of credit card payments and cash payments. These are two really important things to think about here. But first, on credit card payments, if you can prioritize automated payments, money management becomes easier, it becomes less hands-on, and again, more automated. It also shortens your receivable period. And if you can prioritize some customer-facing solutions and work with your families there so that they know when money is going to come out of their account if you're going to make automated payments. Cash deposits and timing. Cash handling policies and procedures are one of the ways to mitigate loss, theft, and waste, and to determine who has control over those things. So if somebody's going to pay you with a check or pay you with cash, when are you going to deposit it? Or are you going to let it sit underneath the keyboard at the computer for 2 weeks and then lose it before it gets deposited? What is your cash deposit timing? Figure that stuff out. If you can get it into the bank every single day, excellent. If you do it once a week, excellent. But we need to know when that money is going to actually be in the bank account. As I was researching this presentation, I also found some information from an organization called Opportunities Exchange, which has some financial management toolkits for both in-home providers, family group, and centers. So if you're interested, there's a hyperlink there, but I'll just read this quick. This is out of one of their financial management toolkits. It's difficult to overstate the benefits of moving from paper to software for managing a childcare business. Providers are able to invoice, collect tuition, and communicate with families in a fraction of the time it takes to do these tasks manually. Added to this, the benefit of electronic tuition collection virtually always results in faster, fuller payment to providers. So not only customer-facing benefits and engagement, but faster collection, better, easier money management strategy if you are using a childcare management system as your credit card processor. A couple other things I want to touch on before we wrap here. Understanding timing, when money will go out, just throwing some clear definitions on what we're talking about here. Money's going to have to go out, whether it's 24 times a year or 26 times a year for running payroll. You've got operating expenses of all the various line items and those due dates on those various things. You've got debt payments and timing due dates on all of those things. It is relatively easy to calendar out when this money is going to need to go out. And when we're being comprehensive, things like insurance payment, an insurance premium might be paid once a year, it might be paid twice a year. but you may also incur copays and deductibles along with that. So keep those things in mind as well when you're managing your money and budgeting for timing for cash out. You've got other things that are relatively easy to calculate, calendar, and quantify, things like quarterly payroll taxes, semi-annual property. You know when that stuff's going to go out. What you don't know is when money set aside for aged asset replacement, scheduled maintenance on equipment, furniture, fixture replacement, vehicle repairs, or damages like hole in the roof on your real estate. You don't know when that's going to necessarily happen, but you can do some qualified assumptions, estimated guesses, scientific wild guesses to be able to figure out and guess when that stuff might happen. And then you also have to plan for stuff you don't know. So in the last couple of minutes here, this is my last slide. Really important to diversify your revenue. I've talked about this concept a lot, and to price accurately, talked about that a lot as well. There's a handful of details here to think about as it relates to being able to manage money. The concept of revenue diversification, if you start selling other things, selling products, renting out space, or utilizing your assets in a different way, or using your teachers to teach different types of classes to kids or to people not in your traditional age brackets, this kind of stuff can spread out when money comes in and minimizes cash flow burden because you're providing something differently that really changes your accounts receivables, period. It also minimizes pressure on tuition collection as being the only source of money in for your business. Pricing accuracy also has to account for discounted and free tuitions, things like staff vacancies and absences, potentially having to double up and pay your staff who has PTO or sick leave time if your company has that policy, and a corresponding substitute and that wage that goes along with it. So building in these types of things and scheduling our part-time kids a little bit more proactively to be able to ensure that we are pricing our services accurately and comprehensively to cover all costs of doing business. Again, all cash out. A couple of final notes here as we wrap. Profit does not equal cash. It's really important to know when zero is not zero. That's your working capital calculation. If you want help with that, please let me know. And then leverage your team. As we close on the top of the hour, I just want to let everybody know our new website is in the process of going live. So it's really exciting for us. There's about, I forget, 20 to 30 new tools and resources for businesses, startup, existing providers, and community folks available on our website. We've got a couple of trainings coming up. The next one on the Tiny Training Series is about one-time funding and sustaining without it. We'll talk about community solutions. And then we've got 3 upcoming trainings with our partners at First Children's Finance. Our Tiny trainings are always recorded and are posted and available on our YouTube page and our new website. If you want my contact information, there you go. And as I hit 2 o'clock, let's get into the surveys. Happy to take any questions if you've got them. And I will open chat to see if we've got any. I don't think we've got any. Thank you, Mandy. Thank you guys for continuing to come. We appreciate your presence here. Hopefully you're getting something out of this. Thank you, Mary. Rhonda, did you have anything?
Nope, I don't. Thanks, everyone.
And with that, it's 2 o'clock. Thanks, everybody. We'll talk to you next time.
Thank you.
Bye.
Bye.